And some say that if silver price go to a certain point, you're going to see all the recycling of silver, and all the silver mysteriously come out of the market and putting a lid on the market. Again, it's the opposite. The higher the price go, the more people are going to hoard and buy more.
Hey everybody, SmartSilverStacker here. Hope you're doing well. Today's video is part 2 of my recent conversation with John Lee. If you want to check out part 1, I'll put a link down in the description. And if you enjoyed today's video, do me a favor, smash that like button, consider subscribing to the channel. And with that being said, let's get right to it.
For me, the only thing I pay attention to is the investment demand for silver. The industrial demand will usually reduce. It's a matter of economics 101. Silver prices go up, the demand withdraw from the market. People find substitutes, alternatives. They delay their purchase. They just go for substitutes. So, but where's investment demand as prices go up to buy more? It's complete opposite. And then if you look at okay, so let's look at silver investment demand, which is 30% of the total silver consumption. It's 300 million ounces per year out of 1 billion ounces. So that's 300 million ounces times $30. That's $10 billion, which is a drop in the bucket. It's a pin drop in the sea. So the point is the analysis, the fundamental analysis, industrial silver supply and demand, silver production, silver supply, in the world when there's hundreds of trillions of dollars, a sea of floating in dollars, is really not much useful. And rather, it's important to stick with technical seasonality and technical and establishing core positions near the lows, and make sure you manage your portfolio responsibly, not over leverage, and just relax, and you just gotta wait. That's really it. Follow the technical trends. The fundamentals and there's also talk about how many silver ounces above ground, right? That's a long debated subject matters. Some say 3 billion ounces, some say 5 billion ounces, and some say that if silver price go to a certain point, you're going to see all the recycling of silver, and all the silver mysteriously come out of the market and putting a lid on the market. Again, it's the opposite. The higher the price go, the more people are going to hoard and buy more. So I don't see the ground silver inventory as a concern. I also don't see the industrial demand as a concern. And I don't see the silver price driven from new applications of silver either. It's strictly investment demand, strictly geopolitics driven, strictly diversification from the well-to-dos that want to stay away from the micro mandates through the adoption of digital currency.
Yeah, well, okay, that's an interesting take on it. That makes a lot of sense, though, what you're saying. The higher the price goes, the more money will flow into it. And it is such a small market, the physical
Crypto.
silver.
Look at crypto. Look at crypto, right? That's a perfect example. It's coming out of nothing. It means nothing. It's worth nothing. And it looks $70,000 a coin. I digress.
No, that's a good analogy, though. I mean, and possibly, I suppose, given the small size of the silver market and the amount of fiat that is out there, I mean, we could see the price bid up dramatically on speculative interest. Again, that's kind of what we saw a little preview of, I think, last year when we saw the problems with the banks. We saw premiums soaring in the physical market, lead times to get your hands on the metal, they went up dramatically. I mean, you might be waiting around for a month before you could get your coins. And certainly the situation is a lot more favorable for those of us who want to get into the physical market at this point. Let me ask you something related to speculative investment demand. One of the things that we've witnessed with this current breakout, with gold hitting all-time high prices, silver breaking through $30, is that the miners thus far seem to have lagged. I mean, we haven't really seen a huge breakout there. Certainly, some of the miners have gone up in price, but nothing like what you've seen in the metals. And most of these miners were valued at a higher level with much lower gold prices and silver prices in the past. So what do you think is to account for that lag in the miners? And do you think that could change? And when do you think that could change?
I will answer that question second, but let me something came to me. I want to make sure I get it out of my chest before I forget.
Sure.
let me be clear. We are at an infancy of a silver run. Okay, not maybe particularly this run, but I'm talking the long haul for 10 or 20 years. We're in the infancy. How do I know that? At the tail end of a silver run, you're going to see interest rate a lot higher. And that will be the end chapter of a fiat system. We're not there. People are still talking about rate cuts. The 10-year interest rate is below the 2-year. 2-year is 5%, 10 years 4.3. And that just shows how oblivious and how numb and how unaware of the fiat system. So the silver is going to go a lot higher. It could easily go to 100, 200. And that's why the thought came to me when we talk about crypto at 70. Silver, if unchecked, could go to 100, to 1,000. Gold could go to 70,000. This is where gold and silver should be, absent of cryptos, which is exactly created to divert the interest into gold and silver. And so I think, first of all, you got to be careful to be not like Paul Van Eden. I don't know if you know Paul Van Eden. Maybe he's before your time. But Paul Van Eden is a well-known analyst. He said when gold was 200, when gold is 800, he's gonna hand the hats and disappear. And he said that the fair price for gold is 800. And he is a very credible person, convincing person. And he put out all these studies, hundreds of pages of papers to support his thesis. Sure enough, he is gone since 2009. You never heard from Paul Van Eden again. So he's hanging his hats. And look at where gold is today, 2,400. Gold and silver is money. It's not. I think the mistake he made is he centered his thesis on the dollar, not on the gold itself. Gold is money. The dollar is just a temporary instrument. So I told him to be clear that you don't want to get too cute. You say, you know what? You've been calling gold at 500, like silver at the 500 or 700 silver price is going to go, and then you cash out at silver at 50, right? That's only the start of the run. And you're going to regret for the rest of your life. I don't think you can be at peace with yourself looking at what happened. So you want to be careful, always to have your core position, not to say, oh, you're going to cash out with the dollar. Like, it is your forever position, not for me anyway. I've been buying silver since 2005. I've never touched it. I don't even know how many ounces I have. They're in the vault, right? Just there. You got to have that mentality. Otherwise, you're going to regret it because you can never time the exit point. I think that's the first point I want to drive at. Now, let's go to the silver miners. And that's an area I am very familiar, and that's my expertise. I've been at it for 20 years. There are 3 reasons why the miners prices are so low relative to gold and silver. Or if you compare the XAU or HUI ratio to gold and silver, I don't even track them anymore because they're low and they keep going lower and lower and lower, right? So even at today's 2,400 gold and $30 silver, the gold is the miner ratio divided by the metals is near all-time low, if not close enough. And so why is that? 3 reasons. First, gold and silver prices are below the cost of living. So the miners are not making money with the current gold and silver prices. The likes of First Majestic, Hecla, I know because I'm a shareholder on and off, as late as earlier this year, that they are losing money at $25 silver, even at $30 silver. And they are withdrawing, they're also deferring their capital expenditures to conserve capital. So they're losing money at $30 silver and gold. 2,400 is a little better for gold miners. But they're losing money. And secondly, there hasn't been a whole lot of discoveries. So the value of these mining companies is going depleting because there's a depleting business. Their reserves is shrinking. An average mine life of a mine is around 10 to 15 years. So the names that you looked at before, like the Newmonts or First Majestic, right? The silver that was there 15 years ago is long gone. So they have to rely on additional acquisitions, development, exploration to find new ounces, which is not economic at today's prices. So the first is the prices just not generate cash flow for these miners. And then the second point is that just like gold and silver prices are heavily managed, the silver mining companies, our prices are also very heavily managed. How do I know? Silver Elephant, as I'm watching the ticker day-to-day basis, I would say easily over 50% of the volume on an average day is algo driven. And so the same people that are managing silver prices are managing silver mining company prices to discourage speculation on silver. Can you imagine that if the silver mining companies are not managed, and then you have First Majestic trading at $50 silver because people know that the silver prices are managed, so they're resorting to buying First Majestic instead for the optionality element, not for the cash flow, right? Then people are you're gonna draw interest into silver and silver mining company, and that is a faux pas. And so they're managing silver mining companies as well as silver prices. Another evidence, they're having plenty of days, and the management has become blatant that Silver Majestic will exhibit peculiar weakness in the share price on the update on the silver. And sure enough, the next day, silver get whacked. I think yes, silver will get whacked. A perfect example, Stacker, look at the First Majestic share price on Monday and Tuesday on silver breakout. It was not heading up. It was very laggy and lackluster. And then all of a sudden you had a silver whack. It's almost somebody had the crystal ball, had the 8-ball, they're spinning, they know what's coming. So the first is that the price is not high enough to generate cash flow as a business for the dividend-seeking investors. Secondly, is the shares are managed just as they are with the metal prices. And then the third is just like it was back in year 2000, 2004. The mining equities is a derivative of gold and silver metal. When I said derivative, it's a combination of 3 factors. Cash flow is one. Optionality, the number of silver and ounces and gold ounces in the ground, and then a speculation of the prices in the future. So it's a call option. It's a speculation. The people that are buying physical today, as I mentioned to you, the billionaires, right? The central banks, they are not the same as the guys that are buying penny stocks or even First Majestic. Way too small. First Majestic market cap is $2 billion. It doesn't even satisfy the appetite of one billionaire to diversify. So they cannot buy these mining companies. So there's a disconnect between the people that are buying gold and silver versus people that are buying gold and mining silver shares. The gap will be closed sometime in the future when mining companies generate enough cash flow, right, to demonstrate. And also as more and more people, retail crowd, get into the market. But for now, just shows you, we're still early stage, that people buying gold and silver are not the retail moms and pops that are buying penny stocks. And this is very, very similar to 2000 when gold broke out of $250. They went up to 500. It's a central bank play and positioning of the very well-to-dos. Silver in the early run-up of 2000 didn't break out of $5 until 2004, 2003. I knew that, I remember, because I bought some silver coins at like $8, silver at $7. And then all of a sudden, like 3 months later, silver went to 15. Because I was scratching my head, I don't understand why silver is so low, right? When gold is broken out of 250, 300 already. It took a couple of years for silver to run up, just not very much like what we have today. And then silver mining company is even later to the game, to 2005 and 2006, before the silver mining company started to heat up. Rest assured, it will come. It's not unusual. There's times where mining companies run ahead of silver metals, and then there's times when silver prices run ahead of mining companies. And what I see is a major run up, and that's why the speculative interest, the retail interest in mining shares are low. And even also for the coins are low. That's why you see the premiums are not as high as it was. And that just tells me that there's a lot more room to run for silver.
So you would say that when we start to see the mines move, that would be an indication that we're more well along the way in the silver breakout?
Further innings, yes.
I want to go back to something you said regarding the dollar being a temporary instrument, right? So in theory, I suppose that the high for gold or silver, anything priced in dollars, is almost infinite, because the value of the dollar, the bottom, I mean, there is no bottom, right? It's a fiat currency. So potentially, you could see the price rise to any conceivable level. With that being the case, I know you said, hold on to silver forever. It's a forever position. But for anyone looking for the signs of a topping in the price, or perhaps looking for an exit strategy, what would you say to them? I mean, perhaps rolling some silver into gold if the gold to silver ratio drops, something along that lines? Or are there any paper assets that you would examine? Historically, the Dow to gold ratio and the Dow to silver ratio has been much lower than it is currently. So I just want to get your thoughts on any kind of an exit strategy from a position in the precious metals, or do you just hold on to it indefinitely, perhaps with the hope of spending the metal itself or something along those lines?
Or so I'm speaking, say, as a trader. So if I'm a trader and I have to report my so if I'm a trader, like for Oracle Commodity, of which is an investment company we founded, just went public 2 months ago. So if I'm a trader, I have to report to my gains in paper to report to my investors, right? So if I'm not a day trader, I'm talking sort of intermediate trend following trader with a horizon of say 6 months to 2 years. How do I spot a temporary top or peak on silver or gold for 1 or 2 over the next 3 to 5 years? There are a few things. The silver to gold ratio is a good example. So every prior silver tops, silver ratio, gold to silver ratio could go down as low as 10 to 30. Right, the gold to silver ratio started at 100 earlier last year. That's extreme, and now it's broken down below the consolidation channel at 75. So I will start scaling back the position potentially when gold to silver ratio is below 50. But I don't follow the ratio too much because the fundamental use of gold and silver differ. It's quite a bit different market, and the size of the market is also very different. A second one would be interest rates. When the interest rates started heading plateau and it's on its way down, like was in the 1980s, remember? And that will be also be an indication of a temporary, will establish a potential top in the metals market. So right now, as I mentioned to you, I think to your show right earlier, like I am emphatic, strong conviction that rates are going to go a lot higher. So what that means is the silver is going to go a lot higher. So interest rate, your call on interest rates is going to also guide you in where silver is going to go, and you want to lighten your position if you believe that the interest is going to start heading lower. And and then the third factor I would say will be silver in particular does have a tie to the economies. And that's why I mentioned at the start of the show, because the Chinese collapse of the economy and the equity market really put a damper on the industrial demand and even some of the retail investment demand in China. So if you are seeing a imminent equity correction or housing market correction for whatever reason you have, okay? I don't see that. I don't see collapse in equity market, but if you do see that, or if the Fed telegraph that, then you want to again lighten your position, particularly in silver, because it is speculative capital. And then fourth, but not least, but even shorter term investors, is you want to watch silver's behavior relative to the dollar index. If you believe the dollar is going to go up, like I am, and I'm actually a dollar bull, and we can talk about that. So if you believe the dollar is going to go up, and if you also see silver trending opposite of the dollar, almost on a mirroring basis on a day-to-day, that is not a good sign. That just tells you that the cartels or the managers, the invisible hands, has a control of the silver market. And they're not going to take down silver like $5 overnight, right? So they're going to start doing their algo trading to steadily bring up the dollar, and then the silver will be a victim in that process. That just shows you there's not enough carry through, enough momentum from silver physicals. I'm not talking paper, because paper is algo. Once you get in the algo exercise, you're going to lose, because the cartels has absolutely unlimited. They control the printing press. They have absolute unlimited margin. So you talk about, the JP Morgan's has a $500 billion margin call. It doesn't matter to the banks. The banks will just print from the Fed. So in short, you want to watch out for the ratio. You want to watch out for the equity market. You want to watch out for the interest rates. You want to watch out for the direction of the dollar, in conjunction to see any exhibit weakness of silver acting on higher dollar index. What I mean by that, you're an expert in the silver market, is like, for example, silver is known and will occasionally, like what happened in the last couple of months, rise with a rising dollar, right? So the silver is acting in defiance of the rising dollar. For silver to continue to go up, you got to see that continued behavior. You're going to see silver disregard for a higher dollar. And you got to see that unwavered conviction from the silver action. And you got to see sustained volume in the futures market. So it's a bit more micromanaging, but these are the signs you got to watch out for an intermediate term trading.
All right. So some things to watch out there for. Now, you mentioned being a dollar bull. I would be interested to hear your case for that, but clarify for me, are you a dollar bull relative to other fiat currencies or relative to the absolute purchasing power of the dollar? Because despite the fact that we've seen some strength in the dollar index, inflation continues to erode the purchasing power of the dollar. I think officially the cumulative level of inflation since 2020 is somewhere north of 25%. So yeah, I would be interested to hear the case there for dollar bull market.
All the currencies are subordinated to the dollar. The managers has a complete control of all the fiat currencies around the world. If the manager tells Bank of Canada to jump to fall interest rates, then the Bank of Canada is going to say how low. Same with the euro, same with the Aussie dollar. Remember back in the days in 2010 when the oil was 150? I remember because I bought a condo in Canada. Back then, Canadian dollar was 20% premium to the US dollar. But now all the currencies look alike. They are indistinguishable, all subordinated to the dollar. And the reason is it's a lot easier to manage one currency than 30 currencies. So that's the reason I'm a dollar bull, because all the currencies controlled by the same people, and these people just want to manage one currency. And this is all done through the Bretton Woods Accords, complete control of the central banks around the world. Now, I want to step back for a bit when you talk about inflation. Why is the high dollar index doesn't translate to higher purchasing power? Why is the inflation so high? Inflation is manufactured. Imagine you are the king, okay, and you run this castle in control of 5 billion people, and you print currencies. Your face, right, is on the paper that you print. You can literally print whatever amount you want. This is no different from what we are today. The wealth measure of a king is not by the amount of paper with his face on it. It's the farms that he owns, the gold and silver in his vaults. It's the control of the newspapers. It's the control of the businesses, the restaurants, the manufacturing sectors, the cars, the horses, the livestock, the agricultures. This is what the king's wealth is managed. Same to today. The king's wealth is measured by how his equity holdings in Google, in Tesla, in Apple, in Microsoft, in the ownership of the Panama Canal, all key infrastructures around the world, is in nanotechnology, artificial intelligence, in latest technologies, and in land, not through direct confiscation with titles in his hand, because that would be too obvious, but through taxation. And the people that work for the king, the king want to make sure they control the people that they work for. The king is through the voucher system, and that is the dollar. What we have today is deliberate debasement of the dollar to reduce the purchasing power and influence of the middle class. So the king can tell them what to do so that they'll do it. There has been too much wealth accumulation of the dollar, of the knowledge, of the mobility, of the knowledge, everything. That the king is now have this 2030 agenda to go back to having you be happy and own nothing. And inflation is a way to do that, to demonetize, to debase the money that you keep in your basement, and also through the digital currencies to exert control on where you go, on the curfews, on what you eat, on where you go. Because the king certainly doesn't want you next to them when they travel to Venice for holiday, right? Or go to New York for New Year's Eve, or go to the South Africa's Cape Town for a beach surfing session. And that is the reason I believe that you have the carbon credits and the climate control, just to ease the traffic for a bit when the king is ready to go on vacation.
Well, that is a fairly grim prognosis regarding the 2030 agenda and the CBDCs, but also I think it's an incentive to get your hands on some physical assets outside
Physicals.
of that financial system. Well, I want to say a huge thank you for joining us again today. Before we wrap this up, you are the CEO and chairman of Silver Elephant. You also mentioned Oracle, your new company. Tell us about those and where viewers can find more information regarding your work.
Silver Elephant is trading on the Toronto Stock Exchange. Symbol is ELEF. And Oracle Commodity Holding is symbol is ORCL. So Oracle is in the business of investing in royalties and investments in mining and in metals. Whereas Silver Elephant, of which I founded the company 15 years ago, and actually is 90% of my time, is the stock just doubled since we talked in the last 4 months. Still at a market cap of less than $20 million with 100 million ounces of silver in the ground. The company is producing silver today, and we haven't diluted in the last 9 months, only 2% of that dilution to pay our directors' fees. So we're self-sustaining, and the share price is still less than 20% from what it was from the top in 2021. The mining companies are a good purchasing point right now. As I said, the shares to the metal prices are still very low. So if you do believe that the metal prices go a lot higher and that the producers are going to start realizing cash flow and dividends, then the junior sector is a good entry point. Right now, they're completely unloved. They've doubled from the bottom, but they're still 80% from where they were just a couple of years ago. Even First Majestic, they're only, what, 30%, 40, the high was 27, right? Now they're like $7. So I think it's a good entry point for somebody who's got a little high risk tolerance. Check us out at silverelephant.com. And for those that want more interesting in my market analysis, you can check me out at the Twitter. Just search for John Lee Silver Elephant. And I just want to finish by saying that the rates, one more time, is going a lot higher. If you have a lot of homes in the United States on a adjustable mortgage, you want to roll them into a 30-year, or if they're investments, the rent's not going to be enough to pay your mortgage when they're renewed. So the risk going a lot higher. Deleverage, cash out your long-term treasury bonds, stay in treasury commercial papers. The rates are going a lot higher. You could be seeing a doubling of the 10-year and then mortgage rate approaching 10%. That just, but not necessarily you got to high for the bunkers, right? I mean, the equities are getting an all-time high. We can talk about why. Now we talk about the king, right? The king can print whatever they want, and they want to make sure they own the assets, which is the Microsofts and the AI and the nanotechnology. So you will not necessarily go bearish and just eating bread in your bunker. This is not the end of the world. And there's always a sun that's shining somewhere in parts of the world. And but you just got to be careful and not to be over leveraging or betting against interest rate cuts. I don't see that coming, and it's a very high confidence call for me.
All right. Well, excellent insights today, John. Really appreciate you sharing those with myself and everyone watching. We'll have to do it again sometime, and we'll see if these calls have proven true as your last ones. They played out pretty much as you called it. So thank you very much. And thanks to everybody for watching. Make sure you go check out John on Twitter or X. I'll put a link to all of his information down in the description of the video. Thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker out.